Hey folks, we're going to get started on Lesson 12, Wealth Creation. And we're going to start by talking about what the balanced scorecard actually is and what it does. It helps you to determine whether you're being able to create wealth or not as an organization. So what it does is it splits out 4 different perspectives that help you answer that question. There's a financial perspective, a future perspective, customer perspective, and the internal perspective. Right, so the financial measures fall under financial. The perception of how things will be in the future, the conditions, will be the future perspective. Can you meet the evolving customer needs over time? That falls under the customer perspective. And understanding what your organization is actually doing, what's fundamental to it that creates that value for your customers, is the internal perspective. So altogether, that makes up the 4 components of the balanced scorecard. We're going to talk a little bit more about each one of these 4 perspectives here on the next slide. Here are the 4 different components, and these are the questions that you would associate with each one of those components. First one says, how do customers see us? That, of course, is the customer perspective. What must we excel at as a company? That would be the internal perspective. Can we continue to improve and create value? That is your future perspective. And also, how do we look to our company shareholders? That would be the financial perspective. Okay, so a balanced scorecard includes some performance measures from key areas that end up being related to your company performance. More importantly is this. It takes whatever mission and strategy you set for the company and helps you set measurable goals. So it helps you figure out, are we moving in the direction of our company's mission and strategy? And if you're not, where do you need to make changes? So top management has to be involved because of their understanding and strategy. So that means that lower level employees of an organization can't be the ones that do their balanced scorecard. So with the balanced scorecard, you focus attention on the most critical measures of performance in one single and simple to read report. Right, a lot of times your executives of the company, they don't have time. You're messing around pages and pages of reports. Balanced scorecard, really useful because it tells you everything you need to know. So it lets managers see some trade-offs among the key measures of the company. All right, so just to mention that the balanced scorecard is useful because it helps you see just everything in that just one single page. Now, there are 4 different components of the balanced scorecard, so let's talk a little bit about that. There is a financial perspective, an internal perspective, a future perspective, and like I said, that's also sometimes called the growth perspective, and then you've got a customer perspective. So these are the 4 different ones that we're going to come back to. We're going to start by talking about the financial perspective. So we're talking about what's in the top left. Now, something else I want to point out here, you see arrows going in all directions. What that means is that each section of the balanced scorecard is going to be informing other sections of that scorecard. So again, you get a company, they want to do a balanced scorecard approach. We're not looking at financial issues in isolation from the internal customer perspective and also future perspective. So let's talk a little bit about the financial perspective first. This one is the one where you've got all of your ratios, right? So we're going to go actually through a lot of these different ratios today, and we'll go through some of the calculations. But you've got debt management ratios, asset management, profitability, liquidity, economic value added, market value added, change in cumulative profit, which is the cumulative profit is what Capson looks at as one of the success measures you can pick. Change in market cap, change in stock price, and also change in free cash flow, or FCF. All right, so this is, if you expand everything here, these are different ones that you'll see. Now, I write shareholder wealth. Keep in mind from earlier class discussions that management can also be shareholders, so this does not necessarily only apply to those outside the firm. A lot of people inside the firm care about these issues as well. I will mention this. You see all these different measures, right? Many different ones. Why don't we just have one, right? And that's a question that simply put, has not been answered. There's been an attempt to try to figure that out. Return on assets is one of the most common ones that are used by companies. Stock price also common. They usually use whichever one makes them look the best. So financial perspective asks, how do we look to our shareholders? All right, so the question is, why can't a company just leave the results to good operations management? So what that means is, why can't you just leave it up to knowing how much to produce, knowing when to produce it, and let that be that? Well, for one is, what if the strategy and goals are flawed, right? If they are flawed, you might not know it, right? You only really would know that by looking at some of the success measures. So in addition to this, there's others. Of course, there's asset turnover would be one issue that would maybe give you an idea that there's some problems. Right, and also financial performance guides trade-offs in operations, right? So sometimes you're trying to decide, do I want to do a higher price? If I'm able to charge a higher price, that allows me to do certain things that I can't do if I have a lower price, right? Do I want to emphasize the delivery speed? Well, if I emphasize delivery speed, again, that makes it more difficult to do certain other things that deal with quality, right? Because I have to spend a lot more money on the delivery. Right? Also, am I looking at the long term? Am I only looking at the short term? And the other thing is that when you're making improvements, you realize there could be certain costs that are created from that. And that's, again, something that you wouldn't really know if you weren't looking at some of these financial ratios. So in order to do the financial perspective, you got to look at what the strategy is, determine if that's effective, and the balance scorecard. Plan for the effects of improvements that you're making to the company, and then understand the link between operations, what it is that you're doing, and the ultimate financial outcomes. So we're going to go through the myriad of different financial perspective ratios. Right, you've got debt management. And what this is suggests improvements that you can make in financing the operations. Asset management is useful because it's going to tell you a little bit about productivity and also about efficiency.
Asset turnover is how quickly you turn a product over. Next is
profitability. This measures how well a firm is allocating its resources. And with this one, there's several different measures of profitability. Return on assets being one of them. All right, let's continue. There's liquidity, and this focuses upon cash flow generation and the company's capacity capability to meet financial objectives. Now, one thing I note here is that you should look at these ratios over time. Right? You shouldn't just use it at one fixed period because that might not paint an accurate portrait of what's really going on with the firm. So you want to take a longer-term perspective. Now let's move on to some other ratios here, the economic value added. So this is going to be useful for us to measure the difference in value between a company's pre and post strategy. So what was the actual impact of whatever strategy the firm was looking at employing? So this examines both the cost of debt and the cost of equity, and it's going to measure your value added for a specific period of time. But we talked a little bit about seasonality in an earlier lecture. That's going to be useful. One of the things this thing is going to be useful at looking at will be seasonality, right? Because it's going to say, look, here is the effect that your sales, if you're a retail company, your sales have in the holiday period, right? You can look at that stuff and then determine really what you need to do, right, in the future. Now, there's market value added too, and this is equal to the future discounted EVA streams. That is economic value added streams. It's going to measure the value added from the beginning of the firm. And then you've got market cap. The simple way to talk about market cap is it is the stock price multiplied by the number of shares. All right, let's talk about some quick financial ratios. And we'll talk about the calculation. I want you to know the calculation for these ratios. The current ratio, current assets divided by current liabilities. Quick ratios, you take your current assets, subtract your inventory costs, and divide that by your current liabilities. Inventory to net working capital, take your inventory, divide it by current assets minus your current liabilities. Inventory turnover is your sales divided by the inventory cost. Your fixed asset turnover is sales divided by fixed assets. Debt to equity, total debt divided by equity. Gross profit margin, sales minus cost of goods sold divided by sales. Net profit margin, profit after tax divided by sales. The one that's very, very popular, return on assets, is earnings before interest and taxes divided by the total assets. And return on equity is your profit after you pay the taxes divided by total equity. And that's going to take us through financial perspective. Now we're going to move on to the customer perspective. So what you're concerned about here is customer wealth creation. Right, so we completed here. We're going to move down here to customer wealth. These are the things that go into customer wealth. One is the number of industries where the company has superior performance based on those customer surveys that you see. Right, so it's not just telling you the positives, it's also telling you the areas that you need to improve upon. That's why this is a scorecard. It's telling you things you got to think about. Right, so number of new products introduced in the last 3 years. The revenue from those products, those new products are 3 years old or less. Those profits from those new products that are 3 years old or less. How many products have you introduced in new geographic markets, including international markets? And also it's the revenue and profit from those products that have been introduced in international markets as well. Now, in layman's terms, what is the customer's perspective? Well, it's simply asking, how do your customers see you as a company? Customers obviously are critical to the mission and purpose. If you don't have customers, you really don't have an organization. So you need to have customer satisfaction in order to survive. The main concerns that customers will have, they do a lot of research on this, and they find that most of the concerns that customers will bring fall into the categories of time that it takes to get the product or service complete, the quality, the performance and service of the product, right? And then also the ultimate price that they pay. Right? If they feel that it was a expensive product, obviously they have higher expectations for performance. They expect quality to be better, expect time to be relatively decent. If it is low cost, especially if it's like a fast food, they expect time to be very quick and quality not to be exceptional, performance service to be so-so. Right? So to implement this part, what you do is you develop measurable goals in each of the different areas. Could require you to set up some external measures just to see how well you are doing, including which setting up key buying criteria. Right? You want to know what the customers want. It's going to measure the revenue and profit streams of new products for existing customers. So definitely one of the emphases of this customer wealth perspective is looking at the last 3 years. Right? Really caring and really weighing the last 3 years a little bit more heavily than any year that comes before that. Right? So let's talk about some of the other issues for that one. Excuse me, real quick. We talked about revenues, profit streams of new products for existing customers. We did not talk about measuring revenue and profit streams of existing products that you're introducing into new geographic markets. Really the way that you would do that is by moving internationally. And that's where that would factor in. All right, let's go ahead and talk a little bit about the next perspective. This one is the internal perspective. This is where you're looking internal to the organization. And the most obvious thing to think about is the wealth of the employee. Right? And employees, I write this, employees are the most valuable asset of the firm, so you're going to need to make sure that you're paying them well and that you're motivating them, making sure that employee morale is overall very high. I think about some cases where employee morale has not been so high. I was talking the other day to one of my other classes about the struggles that occurred as Daimler acquired Chrysler. Right? Daimler, you might know as the maker of Mercedes-Benz. They changed their name since then to simply Mercedes-Benz. Daimler took over Chrysler several years ago, and one of the problems that they had was that they insisted on using the German model. Daimler was a German company. They insisted that they adhere to these policies. They did not sell
the reason to use these new procedures on the employees and impress them that their system was better. And so employees revolted. Right? It was very unsuccessful. I think that they bought them in 2000, I want to say. In 2007, they sold them. And now, of course, they are, Chrysler is now owned by Fiat. So very important to pay attention to the employees. Right, so how do you gauge your employee morale? Well, you can issue satisfaction surveys. This is interesting to the customers. Right, so how does that tell you about employee morale? Well, if customers are not satisfied, one of the main reasons for that is because the employees are also not satisfied. They're not properly motivated. So it tells you there's a problem. Or of course, you can also ask your employees, but one of the problems is that employees are many times afraid to share their true feelings. And they're afraid that it could adversely impact your opinion of them and possibly hurt the employee's status with the firm. So you look at the time to recruit and train new employees. If you've ever worked at a location where you found it was almost impossible to bring new employees in, impossible to get them to agree to work for you, that tells you something right there, right? Because that's someone who has seen enough of the company to get an idea of what it would be like to work there, and they've really told you all you need to know by deciding not to work there. If that happens a lot, it's a big issue. You look at the expense of recruiting and training new employees. If you got to spend a lot of money to recruit, that could be one sign that you have a bad reputation that you need to work on fixing. You look at employee turnover. Turnover very costly. That's you look at that. That tells you how many employees are leaving each year. If you have more than 100% turnover, which many companies in retail will find, that's a problem. Right? That tells you on average you're losing just about every employee you hire is going to be gone within a year on average. Right? So also look at the number of employees hired per department per year. Might tell you that certain departments have more of a morale problem than others. And then look at the stock incentives that you're giving per employee per year. You might want to look at increasing the benefits that you're giving employees. Some companies I've worked for that will do Christmas bonuses, which was very big. They'll give you a bonus for every year that you've been there. You get a higher paycheck. Very good at boosting morale. Very good at keeping employees, right? Retaining them. So this perspective asks, what must we excel at as a company? It's going to measure the processes, decisions, and actions inside the operations. We've talked so far mostly about employee issues, but it goes beyond that. They are important, obviously, because the employee process directly affect the customer outcomes. Now, we talked about employee issues such as employee skills and productivity. Cycle time would also be another one, right? So it also gets into the machinery that you're using as a firm. So you as managers, in this perspective, have to look at what your critical capabilities are that you need to have to satisfy the customers. You should focus on the department or workstation level and have an information system policy and setup that is able to disaggregate summary measures into component parts. What I mean by that is that you need to be able to break each measure down and look at it per department or look at it per decision. So you're going to get a better idea than just knowing that, hey, overall in the company, employees are not very satisfied, right? That doesn't tell you a whole heck of a lot. You got to be able to break it down a little bit better than that. Okay, the last perspective to talk about today is going to be the future perspective. And this is where you're thinking about your positioning for future wealth, right? So are you going to be able to sustain or improve upon your current position in the future, or do you have things that could potentially jeopardize your current success? So things that are included in this one are going to be the number of functional departments that have implemented succession planning, which is good. It tells you that they're thinking about the future. The number of departments who have not implemented succession planning, right? That's key. That's going to tell you what you need to work on in the future. Number of acquisitions, the price of acquisitions. We talked about how a lot of times companies pay a lot of money for acquisitions, but then they do not work out. That's a significant cost and a major problem. Right? What are the possible synergy benefits? What are the actual synergy benefits, right? So you might have thought that I'm going to acquire a company, I'm going to have all these positive outcomes, and it turns out, I've only got about a quarter of them that have happened. I look at the number of scale alliances, number of link alliances. Right? This is just a different way of breaking down alliances, two different types. This would be like related linked type of alliances. This would be more like related constrained scale alliances. Right? Revenue per year from alliances, the percentage of senior management time that's spent on tactical, that is really short-term issues. The percentage of senior management time is spent on slightly longer-term issues, so strategic issues, and the restructuring costs and benefits of the company. That's what this involves. The big question that it asks is, how can we continue to improve and create value? Or is that even possible? This is important because innovation, improvement, and learning are tied to long-term success in the changing environment. So you're dealing with product and process innovation. Here are some measures that might fall under here: percentage sales from new products, the new markets that the company has penetrated, and rate of improvement in other areas. What you want to see is growth. All right. Now I talked about tactical. Tactical is very short term. You want to be able to think a little bit better than that. Right? You want to be able to plan a little bit stronger. So positioning requires a focus on strategic and not tactical issues. Right. So to achieve future wealth, key decision makers, so I'm talking about there is a CEO and senior management, you've got to develop and integrate actions that are oriented to creating that future wealth. So that takes us through the balanced scorecard. Let's go ahead and do a little bit of two different examples just to make sure we've got everything here that we need to have. Okay, so we've got Rockwell Automation. And Rockwell is in the manufacturing industry, right? So what they do is they provide many different products and solutions to companies that are looking to get some sort of automation or some kind of an auditing on their manufacturing stuff, right? So that's one of the things they do. There's many different brands. Very, very large company, right? And a lot of times this is used by the company's supply chain. They will use Rockwell Automation. So they've got lots of different software packages, right, and also different machinery that they're using. So they conducted a balanced scorecard to determine what they needed to do. I started by looking at the financial perspective and what the goals that they have set were on getting short-term results. So the measure that they assigned to that goal, keep in mind you need to have a measure for every goal, was to look at the return on capital. So that told them a little bit about the short-term results. They wanted to reduce uncertainty caused by performance variation. So the way they did that, they assigned a measure to look at the forecast reliability. Do they need to change their models? Right? A lot of times you look at the weather forecast, tells you it's going to be sunny one day, and it ends up being rainy. Well, if that happens quite a bit, then you eventually switch to a different source to get the weather. I know that my allergies always are really bad this time of year. I will tell you that Weather Channel will say that allergies are not going to be a problem, and I look at another website and it tells me allergies are off the charts. Right? So of course I know that I'm feeling allergies. I'll look at the other service. I think it's Weather Underground. I don't look at the Weather Channel because I know that they're not accurate to me for allergies forecasts.
So for the customer perspective, it's all about keeping your high rollers happy while you sort of try to target them, and at the same time you're holding on to your budget shoppers. So you're not losing customers that are a little bit more sensitive to prices. What you can use is a price index to make sure that you do still have prices that are comparable to the competition. Airlines will do this stuff all the time. So what they're going to do is they'll look at what the other airlines are charging, and they will offer lower prices on certain days when they're more likely to get somebody who's price sensitive, while they still keep people that come through and pay a little bit more of a premium, keep them happy.
Future perspectives. They wanted to keep employees motivated. That was their goal. Right? They did all these different things, determined that was what they needed to do. So what they do is they administered a staff attitude survey that would tell them what they needed to do. They tell you if there was a major problem, they needed to do certain things to boost company morale. They wanted to remain innovative. So they looked at the percentage revenue that's coming from new services. The last perspective, they looked at the internal business perspective, right? So they wanted to make sure they were able to meet customer need after it was recognized. First thing they needed to do was to identify the customers, right? And really who comprised their customers. Well, they looked at the number of hours that they spent with prospective customers. They looked at did those prospective customers actually become customers? So it gives you an idea of how many are matriculating into customers. So it gives you good figures so you know if you are churning a lot of prospects and if you need to possibly improve your first impressions with those customers, or possibly change replace your sales staff. They want to look at closeout, so looking at completion of the business cycle. So what they did was they looked at how long did it take to actually complete that cycle. Right? If it took them too long, they're going to certainly lose customers. So that was an easy way to look at that. Talk a little bit about Apple. Right? So one of the things they'd be looking at for financial perspective, they want, let's say the goal was to improve finances, they look at shareholder value, right? Stock price usually is always going up, right? There's been a few cases where it has not. One of the things they will do is they always look at the stock price following new product announcements. If the stock price goes up, that usually means the market is happy with the new products. In some years, it has not gone up, right? And that's telling you that the market is pretty much expecting a better announcement from Apple. They're just not getting it. Customer perspective, look at market share and customer satisfaction, right, to tell you how well they're doing. So they develop internal surveys that they will issue randomly to customers. They have feedback on the App Store about Apple apps, and of course they'll always give you surveys and whatnot if you purchase a product directly from them. Internal business perspective, wanting to make sure that they are hiring, that they're taking advantage of their core competencies. They're hiring people that are compatible with that. Future perspective, or making sure that they are able to continue their R&D into the future. They could look at employee attitudes. So they will survey their employees every 2 years, sometimes more often, which will give them an idea, again, of do you have the right people for the job within the company. Okay, now let's talk a little bit about customer cost versus firm cost. When I say cost for a customer, really this is the price that the customer pays, whereas a firm cost, the actual cost that they pay to produce the product. So they do this calculation. The firm goes R&D, marketing, production, investments. They take all of these costs, plus they factor in a certain level of profit, and they arrive at a price that they're willing to sell the product at. So in Capstem, right, what you can do is if you can reduce, for example, your R&D costs, you can use a TQM for that. If you can reduce your production cost, which you are able to do by increasing capacity, not using as much not using as much overtime, possibly making more of an investment in automation. All these things are going to help it so that the overall cost will decrease, right? And possibly what you can do is you can either get a higher profit, or if you keep the profit the same, the price you're willing to sell can drop. Customer costs, right? They're looking for value in the product. They're also looking to have to spend money for it. They got to spend time for it. You add all these together, and that gives you a price that they're willing to pay. Now, you are going to realize that if the price they're willing to pay is less than the price you're willing to sell it at, you've got a major problem, because that means the customers will not be buying your product. So that's how you do this math and how you do the exchange relationship. Some more things about the exchange relationship: that customers are incurring costs with respect to purchasing whatever product or service they're looking at, and so the firm needs to minimize those costs relative to the competition, and minimize as much as you can. And if the customer does not believe that value and costs are exceeding the selling price, right? So if they do not believe that, then they'll buy it. On the other hand, if customers believe that value and the cost that they pay do not exceed the selling price, then the transaction will not occur. Right? So ultimately, you need to make sure that your customers are happy. Move on and talk a little bit about how this will affect diversification strategies. Right? So what we're talking about is cash cows versus cash hogs. an important dimension of financial resource fit is going to think about whether a diversified firm can generate internal cash flows that are necessary to fund the capital requirements of the businesses, pay dividends, do everything the company needs to do, essentially. Right, so a cash hog business is going to generate a cash flow that are too small to pay for its costs, right, the operations and growth. So you have to always throw more money at it, and you get to a problem called escalation of commitment. Now, a cash cow is the opposite, right? It's generating a lot of cash flows above and beyond the internal requirements. Right, this is all tying into the financial perspective. So a diversified company's businesses exhibit good financial resource fit when the excess cash that's generated by the cash cow business can pay for, right, whatever drag you're realizing in the cash hog business. Right, so, because the idea is eventually at some point cash hog business will pay off, will pay dividends to the company. So you hold on to that by using the excess profit from the cash cow to sustain cash hog. All right, folks, that's going to take us through the balanced scorecard and also talking a little bit about wealth creation. Thank you all very much.